I want to move on to shifting to economics just a bit. Story here from WallStreetWireNews.com. With rates at record lows, is it time to refinance your home? And I got a chart here, Rodney. Look at this. I mean, as everyone can see, rates have just been falling and falling and falling. Of course, I mean, God bless you if you bought a home in the 1980s. My goodness. But even just over the last year, Rodney, we see rates. I mean, just a year ago, we were at about 30-year mortgage rate about just under 5%, and now we're at like 2.7. Rodney, this should seem like it would be a good time for everyone. I would assume the refinance business is booming, and for good reason.
Absolutely. And so there's been a ton of mortgage origination out there right now, and anybody who can lower their costs would be crazy not to. The flip side of that, I keep looking at this, and I write about this in other places, is the flip side of your mortgage is somebody else's investment.
Yeah.
And so when we're getting mortgages at sub 3%, that means somebody else is buying a bond that pays less than 3%. And that someone is the pension fund for the state of Florida or the state of California, or it's the insurance company that, makes good on your life insurance, or it's even you as an individual investor, although you probably buy it within a bond fund. And so the point is, while consumers are getting a great deal when they're taking out debt, investors all the way down to savers are getting just crushed here. And this isn't about two people meeting on the economic playing field and deciding what they want to do. This is about the Federal Reserve stomping on the market and beating on it with the sledgehammer of quantitative easing, which they use to buy bonds and force down interest rates. And so this isn't a natural thing. This is what has been engineered by our central bank, which is crushing savers for the specific purpose of making it cheaper to borrow, not only for people getting mortgages, refinancing, or even buying homes new, but the federal government issuing bonds at almost zero so that they can go spend trillions of dollars. So take advantage of it if you can, but understand what it is.
Yeah, in fact, I just came across, I don't have the numbers right in front of me here, but it was the amount of negative yielding debt around the world continues to climb, which is good for governments so they can pay that
good
back
for governments, yeah.
with the negative interest, but bad for investors or funds. This is their only choice. They can't get one that'll yield them 5, 6, 7%. You're looking at 2.7. And do we expect? There's no indication that that's going anywhere, right? Or anywhere but down, is there?
Yeah. So inflation came out the other day and is 1.2, 1.6%, right in there. It's fairly low, right? And so the Federal Reserve wants it to average around 2. The issue is we had this big drop in prices that happened in March, April of this year when the pandemic started. And so right now we're comparing prices after the pandemic started to prices before the pandemic. And so there's this kind of, jogged lower. Yeah. And so when we get to April in 2021, we'll be comparing after pandemic to after pandemic. And you're going to see inflation jump from, say, 1.4% to 2.5%. Because we're comparing against, a like scenario with, by the way, a big jump in food prices, which is what happened. And so it's going to be interesting to see when we get to the middle of 2021, where we have inflation running above 2% and probably closer to, 2 3/4 for some time. And people are going to start worrying if the Fed is going to allow interest rates to move higher on the long run and then move up short-term rates. I don't think it'll happen that fast, but the first thing that will happen is that mortgages will go up. Because remember what mortgages are. Mortgages are originated by private industry, and then you can go sell it to Fannie Mae or Freddie Mac, or you can get it insured by FHA or whatever. But the first monies come from private companies, big banks, whatever. And so these people don't want to make a loan to you for 30 years at a rate that's below inflation. And at 2.7, we're pretty close to what I think inflation is going to be by this time next year.
I see.
And so as people start thinking that inflation might jump, and this could happen as soon as, mid first quarter, then you'll see those mortgage rates pop back over 3 and get closer to 3.5. And so I apologize for this taking a long time to land the plane.
No, great explanation.
But the idea is, if you want to refi, go do it. Get it locked in, get it done. Nobody is going to look down on you for locking in a refi or an original mortgage at less than 3%. You're going to be a hero. Even if I'm totally wrong and they go down to 2.5, so what? this is a great place to be.
Absolutely. Great analysis there, Rodney. And yeah, so for all of you out there looking at, geez, rates, they're going to keep going down. Well, maybe not, particularly under Rodney's scenario, which sounds very, very plausible.
Well, and I'm even in the group. I need to refi mine. We moved just over a year ago, and we're at, I think, 3.9, which was a great rate at the time. And I could lower it by a point. I'm just lazy, right? I got other things going on. I haven't gotten to it. I actually reached out to somebody and they've been pinging me now for 2 months every week. And I just need to get off the dime and do it. So,
all right, viewers, get off your hump and refinance. Let us know if you're doing that, if you're considering it. Love to get interesting to see what's going on here. It is, as you say, mortgage rates under inflation, or it does that's a strange scenario. So keep that in mind, everyone, and don't be lazy like Rodney.
Exactly. That's the moral of the day. Don't be lazy like Rodney.
Okay.